Hello and welcome. You are listening to the Investor Lab. My name is Goose.
My name is Gabby.
And this is the auditory epicenter for passionate people seeking a life for freedom, choice, and abundance. Welcome.
Hello.
Welcome.
Hello. Hello.
Gabby, what are we talking about today? Why is it important? Who's this for? Whoops. I just broke Gabby.
You broke me.
All right, so whilst Gabby's in recovery mode, what we spoke about today was 5 key metrics for selecting emerging markets, right? So
Yes.
we're talking about what an emerging market. Gabby's back.
Hello.
What did we talk about? Okay, so we spoke about what is an emerging market, how are they different from hotspots, why you would want to buy in an emerging market, and then we talk about some really powerful metrics on how to identify them, including some mathematical formulas and all kinds of other really interesting stuff. So
yes, the formulas are very helpful, guys. So pay attention. Get a pen. Get a pen, write them down. Good morning.
Good morning. Gabby's back.
Hello.
And she's here to tell you to pay attention. Listen up and study up, guys.
Oh God.
Now, if you, I don't know. I just want to put this out there that if I sound a little flat in this episode, it's because I'm struggling with insomnia. So if anyone's got any kind of hot tips on how to overcome insomnia, just send us
coffee for you.
No more coffee. No, less coffee.
Yes.
Get off the black crack. So. Okay, all right,
Anyway.
we'll work it out. Anyway, we're not here to talk about coffee, we're here to talk about emerging markets. And if you enjoy this episode, make sure you share it with somebody else, let them know. Make sure you subscribe on whatever platform you're listening to. And if there's any other kind of cool way to interact based on where you're listening to it or watching it, whether it be on YouTube, do a little thumb up and ding the bell and do all the other cool stuff that they tell you what to do. And likewise on any other platform, Facebook, LinkedIn, etc. We love hearing from you guys, so give us feedback. And of course, if you want to check out the other episodes, head to theinvestorlab.com.au. There's also a bunch of free resources there that you can access, download, all of that good stuff. And of course, if you need help to identify emerging markets and select great properties that can give you outsized returns and allow you to achieve a greater life, a life of freedom, choice, and abundance much faster than you ever might have thought possible, then make sure you let us know as well. There's a contact form on the investorlab.com.au website. So without any further ado, Gabby, let us get stuck right into it. And guys, we look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. Gabby, what's going on?
Good day. Good day.
It is a good day, isn't it?
It's a lovely day. I'd sound like such a hippie every time I say that. Well, we just had all of that rain. I'm hoping it's now. I'm saying like it's ended, but all of the rain in Sydney. It's the first blue sky we've seen in probably a week. Yep. So that's why it's a lovely day.
It is. It definitely is. And how are you today? What's been happening? Tell us a little story. What's been going on in Gabland?
Look, I'm not the best storyteller, but
I keep hoping that I could just keep asking you for stories that one day
doesn't really
it's like
work
a muscle.
that way. So it's
flexing the story muscle.
Story muscle. Story. I really have nothing. I'm really not very good at this.
No, that's okay. It's all good. I just think it's funny. It's like normally, so in previous episodes, it's like, hey, Gabby, what's going on? Well, the sun is shining, the birds are chirping, blah, 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 blah. It's pretty much the same every episode. And now it's like, well, the rains have stopped and we can see boats. So
we can see boats.
Which is pretty cool.
Yes.
Great. What are we going to talk about today?
We're going to have a chat about emerging markets.
Why? Do you want to ask me? Am I asking us? Am I going to start interrogating you? What's going on here? What
I'm going to interrogate you, of course. We're going to chat about this because particularly, with real estate activity in the last 6 or so months, has really picked up. And so everyone's talking about, real estate's so busy at the moment. And a lot of people, are looking to get in, which is great. Coming out of COVID, people are starting to make moves again. But then the classic is that people usually jump to, these hotspot locations that you hear about through the news and through media. And then so we've been speaking with our clients and kind of explaining actually how we identify them before we get to them. before they become a hotspot. So all of these locations that people are talking about, we're actually looking for emerging markets that are becoming hotspots, right? So we just thought we'd touch on this a bit.
Sounds good. Where do you want to start?
Well, like I just touched on, we have talked about hotspots quite a bit before. So I really want to know, what is the difference between a hotspot and an emerging market? Or what is an emerging market?
Okay, so let's dig into that. So I'll come back to what is an emerging market. Or maybe we'll come back to how it's different from a hotspot. Let's start with what is an emerging market. So an emerging market is essentially, and you can think about this in a global scale. So often when when you hear the term emerging market, it's typically it's more commonly referred to when you're talking about like global markets. And so it might be, so for example, Vietnam is an emerging market. You've got your main superpowers, which are, your Russia, US, China, and you've got some like tier 2 powers and stuff, which would be like Australia and, whatever, all these kind of places. They're kind of like the big ones. And then you've got emerging markets. So they're the economies which are undervalued, haven't fully realized their economic potential, are starting to grow quite quickly, all of that kind of stuff. So, India has turned into a superpower now, but it is still an emerging market because it's still underutilized in terms of its economic development. Vietnam is a really big one at the moment because they are pushing heavily into modernization of their economic standards in a lot of different ways. So finance sector and heaps of really interesting stuff there. Some parts of Africa are emerging markets, and they're the ones that are on the move, basically. So not just economies which are inherently not as good as, say, the US or China, for example, but the ones that are transforming. So the ones that are actually on the move, that are emerging, right? So the key point there is that they are growing, right? And that there is an impetus for them to grow, and and that they are moving in the right direction. And this is the interesting way to think about it, because when you take any of these kind of global financial constructs or economic constructs and start to think about how you can apply them on a more micro level, you start to see a lot of similarities. It's quite fractal in a certain sense. So when we're talking about emerging markets, what we're talking about, if you think about US being a blue chip suburb, and China being a blue chip suburb, and the UK being a blue chip suburb, and all of this kind of stuff, or that you could liken them to being places like Sydney and Melbourne, where the economies have been strong for long, they've been in power for a long time, their total national GDP is higher, blah blah blah. And then you can kind of go, okay, well, where's the Vietnams in Australia? Where are the markets which are transforming, and what is actually causing that transformation? And also, how would I judge that? Because a lot of things that go into identifying an emerging market on a global scale, like on a macro scale, you got to think about, what are things like corruption and government stability and things like that. But these all apply actually even when we're talking about real estate markets as well. Because if you've got a local government council where there's a high level of corruption, which happens, I think like in Geelong, basically the whole council got sacked, right? Yes. And even in Ipswich, they had their mayor or whatever, who for years he was like the Don of Ipswich. He was like the boss, and everyone loved him, and he was like responsible for heaps of economic prosperity. Turns out he was on the take, So you do have these kind of considerations even on local government levels. So you've got that kind of stuff happening there too. You've got stability. What are the government changes going to be? All that stuff. So you can kind of see a lot of similarities. Now, there's another way to think about emerging markets as well, and it's like small cap stocks versus blue chip stocks. Okay, so blue chip stocks being, I don't know, like Fortescue, BHP, basically, the ASX 200 or Fortune 500 companies, stuff like that. Big behemoths where the total net value or the market capitalization of these companies is tremendously huge. You've got companies like Accenture, for example, where they do about $45 billion a year in revenue, and they've got 500,000 employees, right? They're a Fortune 500 company. But then you've got smaller companies that are small cap stocks. So, for example, Vulcan Energy, for example, is a small cap in the energy sector, which is doing carbon neutral lithium or something to that effect. It's grown by something like 10,000% in the last 12 months, or 1,000% or something like that. It's crazy. And so you've got these differentiating factors between identifying markets and what they're for. So I think using shares to illustrate sort of blue chip and emerging is a really interesting example, because a lot of people intrinsically understand that a little bit more. Yeah. So if you think about, I don't know, let's talk about BHP. If they create $1 billion in profit in a year, that might result in, and again, this is not like actual math, but that might result in, I don't know, a 10% or a 5% increase in the share value, for example. It's going to be relatively minor. Still good when you're looking at the total company market cap and all of that kind of stuff. But if you have a company which is much smaller, maybe it's a $10 million company, if you applied that same amount of profit and made $1 billion in profit, that would go from like, I don't know, a 2-cent share to a $100 share or something like that. Mm-hmm. And so the market movement can be much more significant. Now, the key, of course, as with any of these kind of things, is how do you identify which assets or which markets or any of that kind of stuff, which ones are moving and which ones are just cheap, right? Because cheap does not equal good. And so, for example, I have an interest in small cap stocks. I'm not a trader or anything like that. I just have an interest in it because I like small companies. I like the story. I like the potential growth rates and stuff like that. But what I find quite interesting about it is there's, I don't know, maybe like 2,000 companies that are all small cap or micro cap, where you could buy shares in them for less than, well and truly less than $1, sometimes less than a cent. But that doesn't mean that just because they're cheap that you should buy them in the hope that they're all of a sudden going to grow by, thousands of percent. And so the question then is, how do you assess the value? Now, in the big hedge funds, there are, and interestingly, in the money markets or in the investment markets at the moment, there's a lot of movement going on because there's a lot of disruptive new funds and stuff starting, and but they're targeting people that are specialists in different areas. So like emerging market specialists, small cap specialists, people that go and do an assessment on these kind of products, these asset types, these locations, whatever the case may be, to identify unlocked value. And so when we can kind of explode this and shrink it in and out, zoom in and out to understand that in different ways. Does that kind of explain what it is? Yeah,
it does. Yeah, I'm thinking about equivalent in real estate would be like areas where just because they're cheap doesn't mean that it's a sign that it's going to grow. So a lot of places where people can get crazy yields because the price point is so much lower, but it doesn't necessarily mean that it's got the fundamentals that the property needs in order for it to eventually emerge.
Totally. And you've also got volatility. There's a couple of other things in there as well. You've got volatility and you've got longevity as well. So, it's easy for an emerging market to have a spike. And you apply this again to shares, countries, whatever, it doesn't really matter. It's easy for it to have a spike, but if it's not sustainable, it's not gonna continue on. So looking for, and you can also, just like with a business and with a country and also with the real estate market, it's very hard to time the bottom and the top. So what you need to look for is not, is this cheap? Is this priced less than it once was? Or anything like that. You're actually got to look for what are the signs that this is going to transform into something different, because just buying cheap or just trying to like time or enter into markets when they are low is not actually really a strategy unless you can understand what the future holds. And I think this is actually one of the biggest issues that I see there's a lot of companies out there which will try and predict growth, which is awesome. And this is sort of something that we're leaning towards as a business as well. But the methodology I see with a lot of these companies, and it was interesting. I saw an article in AFR, I don't know, last week or something like that. And it was like talking about the suburbs that are predicted to have 30% price rises and whatnot. So naturally I read the article. And I was looking at the methodology of the company and how they do the predictions, and they're only ever looking at historical data. So what they look at is things like, auction clearance rates, but it's all historical. Now, historical is important because you need to understand what the story is to get there, but you also need to think about, okay, where is this going? What is the potential that is about to be unlocked here?
Yeah, cool. So how are they different from hotspots then, emerging markets?
It's a good question, right? So I think one of the most common problems that I see that property investors have is that they hear about hotspots and it's already too late. When you've already heard about a hotspot, it is currently hot.
Totally. Yep.
It's not emerging. It's already there. It's already hot. And so that's actually a big issue. The way that I think about that, just kind of using the same like shares kind of analogy. It's like, imagine if you bought Afterpay when it was, look, I don't know where Afterpay started as a share price, so don't take this again as like actual, but imagine if you bought Afterpay when it was 10 cents, a share.
Yep.
Now, most people, like the people that bought in early into those really powerful emerging shares and stuff, have done very, very, very well. Mm-hmm. But the people who came in late, when they're reading about it in the paper, and it's like, oh my God, or the buy now, pay later stocks, yeah, they're going up. Yeah, we should buy some of that. They could buy too high and then lose a bunch of money, right? So that's the same thing with hotspots. Pretty much, if you've already heard about it, if you've already heard that it's a hotspot, it's already too late, pretty simply. Yeah. So I think that's the key differentiating factor. And when we actually did the Hunting Hotspot series, the premise of that, if you go all the way back to the first episode, was how do you, so it was before the hotspot. Mm-hmm. So it wasn't like, how to identify a hotspot? It was before the hotspot. How to identify locations that are primed for growth? Because that's really the key factor. That's, I think, the biggest differentiating factor between success and failure in real estate is your ability to understand the markets. Now, I've said this before, that anyone who says you can't time markets is just an idiot. You can't time the bottom. There is no way to know, has it reached its bottom or its top?
Today is the day.
Yeah, because it's like they're just two static moments. But you certainly can time your entry into a market based on a bunch of characteristics, criteria, metrics that we can measure to assess, is this an opportune time to enter into the market? Because like at the end of the day, if you look and you look around the country at the moment, and there are many, many markets which are booming, and they're not the ones you want to buy in. They're the ones where you're going to be having multi-offers on properties. They're the ones where you're reading in the paper and it's like, oh my God, this property's just sold for $100,000 more than the reserve, and all of this kind of stuff. And quite frankly, you're not going to get a good deal in those markets because you're already pricing in the growth. People are pricing in the FOMO. And so the way to get a leading edge advantage, the way to get accelerated returns in real estate is to identify emerging markets. But again, you've got to be really careful, because it's easy, if you don't understand what to look for, it's easy to mistake a cheap market for an emerging market. And if you use that metric, you're almost certainly going to go wrong, because there's over 15,000 different suburbs in Australia, and a significant amount of them are going to be cheap, and a significant amount of them also will have, maybe had a high price at some point. There might have been something in their past which caused the prices to be high. So it could be a mining project, or it could be, I don't know, it could be anything, right? And that price may have come down, but just because it has once been high and has now come down doesn't, again, mean that it's going to go back up unless there's a significant impetus for that kind of economic change in the area.
Cool. Yeah. So you just touched on FOMO there. I just want to explore that a little bit. So I guess if you take it from a psychographic perspective, I guess it's most people, when they hear of a hotspot in the media or whatever, and think that, okay, I'm going to go and buy there, now's the time to go there. Yeah. Classic for the last 12 to 24 months is Brisbane. So many people still saying, got to get into Brisbane now, when it's far too late. Through our methodology, it's too late. But I guess from a psychographic perspective, it's way less volatile for most people, and they're much more comfortable going into somewhere that has way less risk from their perspective. Yeah. To go into a market that is already showing some signs. They may have missed that first, upswing from when it emerged as a market, but there's still some activity
Yeah.
and they're going to ride that. And I think most people, from a psychological perspective, that's what brings people into those markets, because they're like, oh, well, it's probably going to do something, and that's better than the risk of, trying to get time a market somewhere else and getting it wrong.
It's good. It's a great point.
Does that make sense?
It makes total sense. It makes total sense. And it's a really great point. And what you're talking about is risk profile, more specifically. Now, is it more or less risky to buy a share in a company that is a Fortune 500 company or an ASX 200 company or something like that? Is it more? Do you think it's more likely that BHP is still going to continue to be around in the next 10 years, for example?
Yes.
Yeah, exactly. Yeah. The likelihood, if you invest in blue chip stocks, for example, and I'm using this analogy so that we've got.
No, it's an accurate analogy.
Yeah, so you're more likely to get a lower percentage return over an annual basis. And don't get me wrong, it'll still be good. Like, let's just say it's 6% compounding return. That's great. That's awesome. But it's more likely to be a lot safer, particularly if you've got an index. If you've got if you invested in an index of the ASX 200 index or whatever, it's more likely that you're going to get consistent returns over time with a lot less volatility and all of that kind of stuff. Now, don't get me wrong, I hate volatility. I don't want to invest in a risky market. So this is why we need to understand, how do we identify them, right? You don't want to take risks. I think risks are stupid. But just in the same way that Warren Buffett has a process to identify the companies that he wants to invest in on a value investing basis, PE ratios and stuff like that, he's got a methodology for doing due diligence to go, okay, why would I choose this company over another one? We also then have a methodology to be able to do that as well. So again, just to illustrate that point, it's a risk profile, but that doesn't mean that you want to go and take a bunch of risks, right? You want to make sure you're doing the homework. Risk, I think, only comes when you lack knowledge and when you lack information, because there's inherently, I think, in many ways, less risk and potentially higher returns if you understand. If you can understand the information, because I know plenty of people who have bought in the greater Brisbane area, and for the last 2 years or more have seen zero growth. And I've then gone and looked at the data, and they're probably still going to see zero growth or zero adjusted inflation adjusted growth for the next couple of years, because there's just not a lot going on there. And so that inherently has a risk as well. So just following the crowd because of FOMO can actually lead you to make some bad decisions as well, because you're still not looking at the information. You're still not making an educated and informed decision. Just in the same way that you could buy, I don't know, you could buy shares in Rio Tinto thinking they're nice blue chip and fantastic, how safe, and then they go and blow up an Aboriginal site and their share price plummets because because they've got bad PR and they've damaged a cultural icon and all of this kind of stuff. That's not safe either, right? Yeah. So you've got to understand these risks and got to understand there's risks in every situation. So then you actually got to look at from a risk reward basis and make an educated decision on that. And look, what we do in targeting emerging markets isn't for everyone, right? If you are happy to have a 30, 40-year investment journey, if you are happy owning 1 or 2 properties, if you are on a high income and you are looking for tax incentives as opposed to cash flow incentives and stuff like that, then cool. All right. I don't know. Maybe go buy something in whatever, Surrey Hills or something. Right. It'll work out just great over the long term, because the demand for Sydney, I don't think, is ever going to go anywhere. It's a beautiful city with a lot of economic power. It's blue chip. It's the US economy in Australia, right? It's that.
Yeah.
So you can put your money there. That's all good, but it really depends on what you're trying to achieve. Now, most people I know, if they can get their results faster and better and sooner, rather than wait 20, 40 years and still maybe not get the result they want, they're going to choose that. Because also what happens when you add speed is you actually decrease risk. Because, for example, let's just say you go, well, this could take me 20, 30 years because I'm buying in a market that I don't know, but I'm just going to chuck my money there and see what happens, and property always goes up. It might not really perform as well as it should, and you're going to have to wait 20 years to work that out, right? If you have the ability to go faster by investing in emerging markets and getting higher cash flow and higher growth and all of that kind of stuff, that's going to allow you to build a bigger portfolio that's more diversified, and a more diversified portfolio inherently has less risk. If you have 10 properties as opposed to one, and one property goes vacant and loses its tenants, that's only 10% of your portfolio as opposed to 100%. Yep. So there's a lot of other factors that by investing in emerging markets, you can actually decrease your risk by having a greater spread and also simultaneously increase your returns. So I actually think it's, in my opinion, it's actually a lower risk strategy. But again, you have to understand the info.
Yeah, cool. Okay. So just going on from that risk mitigation perspective, understanding the information is so key. But what kind of information do we need to understand?
Good question. So internally, we have 147 different metrics. I counted them up just before we started recording this episode. 147 different metrics. But there are a few that, if you can work them out, would give you a significant advantage to identify the markets to enter into. So one of them, a big one, is supply and demand. Now, supply and demand makes up about 33% of the weighting of a growth factor. Okay, so on a statistical basis, supply versus demand isn't 100%. It's about 33% in terms of, how much of growth can be attributed to that single component out of a suite of other different components.
Yeah, still substantial there.
It's massive, right? Yeah. So it's a huge win, right? If I could have 33% better sleep, I'd take it. It's not a small thing. So there's mathematical ways to work that out. There's an interesting, and I'm going to give away a bit of our secret sauce here with some of this kind of stuff, but
it's why we're here.
It's why we're here. Why the hell not? Okay, so an easy way to work out supply and demand is the sales listings from the past month divided by the total number of sales for the past 12 months. And that will give you a ratio that you can use to plot on a graph and give you an understanding and if you track that metric over time, you're going to be able to see what the change in that market is and whether supply is increasing versus demand. Okay, cool. So there's some little sneaky little maths in there for you as well. In fact, why don't we go through like some of the mathematics behind some of these key points as well?
Awesome, great.
Okay, so supply and demand is obviously it's a pretty easy to understand factor. It's like if there's a town and there are 1,000 houses and there are 1,000 people that want to live in houses, then you have equilibrium. It's a very simple way of thinking about it. Mm-hmm. If you are in a town and there are 1,000 houses and then there are 1,000 people and then somebody creates another 1,000 jobs and therefore there are 2,000 people that want 1,000 houses, then you have twice as much demand as you have supply.
Yep.
Okay, and then that is going to be reflected in the sales volume data. And you'll be able to see what that trend is. You obviously want to look at trends, not static numbers, because data viewed in isolation is just going to steer you in the wrong direction every single time. So you need to be able to track the trends. You need to be able to see which direction it's going. But that alone is not going to give you the full story, right? So we'll talk about a couple of other key metrics that you can kind of layer up to start to paint a fuller picture. But supply and demand is a huge one. Now, the other thing, there's another. Do you have any questions on that?
No, so I just wanted to clarify, like, prices go up when there is more demand because it basically incites competition between the people who are bringing the demand.
Yeah.
So instead of having one person trying to get one property, there's two people trying to get one property. So there's a competition between them.
Exactly.
Not literally, but from a
pretty much
pricing
literally.
perspective, that's what.
Well, pretty much literally, because what'll typically happen is if there's more demand than supply, that's typically when you see markets moving to more auction-based sales as opposed to private treaties, right? Because they want to put people in competition. And then quite literally, the two people could be standing there and be in direct competition and push up the price to try and beat the other one. So yeah, you do get into direct competition, not even just metaphorical competition. And that's what pushes prices up.
Yep.
And the same thing goes on any other financial instrument or any other asset class. If there's an old saying in business that when demand exceeds supply, raise your prices. Simple, right? So, and that's the easiest way to make more profits in any environment is to charge more for the same thing rather than sell more of the same thing at the same price. Yep. So the diamond market is a really great example of that. Apparently, there's no shortage of diamonds. They just deliberately restrict the flow of them to the market to keep the supply versus demand metric in the right place, to keep the value proposition the right way. Make sense?
Yeah. And then like the flip side of that, when we see when demand is exceeding supply, so then their prices are booming. And then that's when you start seeing new developments come in to try and build new lots to house the new people in those areas. But then at some point it tips back, right, where suddenly there's more supply for the amount of demand of people in that area or coming to that area. And then so there's less than one person per house available. So there's negative competition, if that makes sense.
It makes sense. It makes sense, and I like the way that you thought about it because that actually leans into another key metric. So there's 5 that we want to talk about at the moment, right?
Yep.
So one is supply and demand. So we've kind of covered that and how to calculate that. Future supply risk, though, that's what you're talking about because that affects. Okay, so if the current supply is less than the current demand, that is good. But what is the future supply risk? And so I kind of spoke earlier that there's a lot of companies out there that are trying to say, hey, you should buy here now, but they're not looking at the future. Yeah. And there's a few things that we want to look at. We want to look at what are the growth drivers, what's the future supply risk, a whole bunch of other stuff as well. But it's a good opportunity to jump into future supply risk because what typically doesn't happen is it typically isn't a case of a market exists and then all of a sudden jobs get created and demand increases and supply decreases relative to demand. And then some developer goes, oh, I can see a gap in the market. I'm going to go and put in my application. That's already happening in advance because they're looking for growth drivers as well. They're looking for emerging markets. Yep. So what we need to look at whenever we're looking at emerging markets is what is the current known future supply risk, because developers don't just walk along, buy a bit of land and start building houses. It's a process. It takes about 18 months or can take longer as well. But, you've got to draw a line in the sand on how you want to measure the metric. So one way to measure future supply risk is monthly building approvals, 18-month average times 100. Right, so you can get the actual building approval rates to go, okay, how many new dwellings have been approved in this? So we'll talk about this mythical town of 1,000 people, 1,000 houses, and then 1,000 people, and then they've created 1,000 jobs. So there's now 2,000 people want to live there, and then you can go, okay, well, damn, there's twice as many people want houses than we have houses, but how many houses are being built? How many houses are about to be built? Because there could be a big development of 5,000 houses that's about to hit the market. And then, then the supply risk could be so significant that it'll soak up any potential people that want to live there. And then the growth could go down, not up. It could be inverse. So you've got to look at that. And you can look up the building approval rates, go, okay, how many houses are being built? Based on what we know about the current levels of demand and the velocity rate of change, like how much is demand, at what rate is demand exceeding supply? Because it's not a static thing. You'll look at the trend line, you'll go, okay, the demand level is increasing by X units per month, and the supply level is staying the same or so you better see the velocity rate of change. You better use that to imply where you think it might go based on some other factors as well, which we'll talk about, growth drivers and stuff. But the future supply risk is the monthly approvals, the 18-month average monthly approvals times 100 divided by the number of existing houses in the market, right? And that's how you can then work out, okay, if there are 1,000 houses and 2,000 people that want houses, and there are on an average of 20 houses being released on the market every month, then in 5 months, we're going to have an extra 100 houses. And, you can start to imply what that is going to mean from a supply risk perspective. And that's going to give you some insight on whether demand is going to stay significantly higher than supply or not. And that's going to give you that'll allow you to look into the distance a little bit and say, okay, well, what's happening here? What's happening here over the next 18 months? And is this likely to, is the demand supply ratio likely to get better or worse in the foreseeable future?
Cool.
Super cool. That's super cool because a lot of people don't understand how to work this kind of stuff out, right?
Yeah, for sure.
So a couple of other leading indicators as well is obviously rental vacancy rates, but this is any of this stuff viewed in isolation is not going to lead you in the right direction. So you got to look at all this stuff together because rental vacancy rates could be coming down. I can think of dozens of locations right now where the rental vacancy rate has gone down and the median rents have gone up, which are two other key leading indicators. But for a variety of reasons, I think they're not going to be significantly good emerging markets because either the future supply risk is too high or the project pipeline is too low. So just to kind of touch on those points, right? So the five key factors we're talking about today are supply versus demand, rental vacancy rates, median rents, project pipeline, and future supply risk. So we've kind of covered supply and demand and future supply risk. So median rents, this is interesting, right? So yields are good. Yields are a good metric. We always talk about yields. Oh, yeah, we want good yields. We want good yields. We want good yields. However, the yield of a property, i.e. the revenue it generates relative to the price, is exactly that. It's relative to the price. So the question then would be, could the yield of a property go up if the prices of a property were going down?
Yes.
Yeah, exactly, right? So just measuring yields is not actually a good enough indicator of the demand potential in an area or what's going on there. What we actually want to look at is are rents increasing? Now, if rents are increasing, we kind of covered this in the last episode. We want to see rents increasing. That's a precursor to growth and all of that kind of stuff. But if the rent is increasing relative to the property prices staying the same or slightly growing, then that's going to create a higher yield. But you want to actually track the median rents as opposed to the median yields, because if you have an area where, I don't know, just for example, there is low economic stability and people are like, I definitely don't want to buy a house here, but I have to work here. Therefore, I'm going to rent. I can think of loads of mining towns where that would be appropriate. Then the rents go up, the yields go up massively, but the property prices maybe don't go up as much. And the property prices may go down, for example. So you've got to look at rents. You got to look at rents as the factor of a demand, as opposed to just pegging yields off the property price. So median rents, you want to look for increasing there, so you can kind of track that. There's loads of ways to get the data. SQM and stuff like that is really good. Rental vacancy rates. So what we want to look at there is the number of rental listings divided by the number of investor-owned properties. Okay, so if there's this town of 1,000 people, and there's 100 listings, rental listings, then that would be a 10% vacancy rate.
Yep.
Right? But if there was only 100 rentable properties in that whole town, i.e. the other 900 were all owner-occupiers and weren't up for rent, were never going to be up for rent, they weren't renter properties, then you would actually have a 100% vacancy rate.
Yeah.
Okay, so then that would imply that it's got a pretty weak rental market, right?
Yes.
And so I think this is another thing that gets overlooked. Now, it's never going to be that extreme, but it is very interesting to look at what the differentiating factor is, because when you're identifying markets that maybe have a vacancy rate of, I don't know, 1%, what you can actually find is that when you apply it to not the total number of dwellings in a market, but the total number of investor-owned rentable dwellings in a market, then you actually get a much clearer image of what is the rental demand in that area. And you might find that vacancy rate changes from a 1% to a 3%, which is a pretty interesting kind of consideration as well.
It makes sense.
Let me ask you, Gabby, is this helping you understand the emerging markets? Because I know that I'm usually digging into all the data stuff a little bit more than you. Is this helping you to kind of understand these markets as well?
Yeah, it is. I think it's a lot of it is secret sauce, right? So a lot of it is the principles, I think, make sense, but hearing the math of how we're identifying them and what actually is supply and demand, like this is the formula to identify what the supply and demand is doing right now.
Yeah.
I think that's really helpful.
Yeah, totally. Yeah. Well, I hope it's helpful. There's going to be some nerds out there that are going to start building graphs and stuff. Awesome. So here's the other thing that I wanted to talk about. We've spoken about 4 factors now: supply versus demand, rental vacancy rates, median rents, and future supply risk. Now, future supply risk is obviously looking into the future. So if we split this in half sort of thing, supply and demand, rental vacancy rates, and median rents, that's all like now and historical. That's That's basically all historical data up to today. That's what you can track.
Yep.
What we want to do is we want to look into the future, and this is where the differentiating factor comes between successfully picking emerging markets. We spoke about future supply risk, but another really interesting one is project pipeline. So what we want to look at, and there's formulas for this as well, right? So if you have a town that has, I don't know, we're talking about the same town, 1,000 people, 1,000 houses, right, and 1,000 people, and then there's $2 billion worth of new projects happening in that town, and you can assess the economic impact of that town. Is it long term or short term? And also what the jobs that are going to create, both short term and long term, because there'll usually be a construction phase and then an operational phase and all of that kind of stuff. You can then use that to imply what the ongoing economic prosperity of that location is going to be. So the easiest way to think about that is if you have this town and then there's a $1 billion road getting built, but all of the contractors are from out of town. No one spends any time there. They drive in, they lay some tarmac, and they drive out again, and none of the money stays in town. Then it really doesn't matter, right? Mm-hmm. The town's going to get a nice road, but that's it. Yeah. But if there is a project which is going to stay in that town and the money is going to be spent in that town, or the workers have to move there either permanently or temporarily, that is going to mean that the money is going to get spent locally, and it's going to filter into the broader economy. So the formula that we can use for that is the project dollar value divided by the population size. Then divide that by the economic timeline times the completion probability. Okay, so it's a little bit more complex to work out. All right, but if you consider all these factors, if the economic timeline is how long is the money going to stay in the town, mm-hmm. that's the timeline. Is it likely to have an economic impact for the next 1 year, 2 years, 5 years, 10 years, 20 years? So, for example, an example of a long-term economic impact project would be a redevelopment of a port, right, to turn it into a international trading facility or something like that. That's going to have ongoing impact because it's going to transform the local economy. It's going to drive more commerce. It's going to have all this other kind of stuff happening around it. A short-term project would be something like we're going to do a renewable energy project, which is going to generate 10,000 jobs for the first 12 months and then 5 jobs for the next 20 years, right? Yep. That would be a shorter term impact. I wouldn't have as much ongoing. Now, the other interesting thing is the completion probability, right? It's all well and good to go, there's all these announcements about, billions of dollars of projects happening here, but how can we weight that? How can we understand the probability of that becoming true? Because we all know politicians are famous for basically talking shit. They'll say whatever needs to be said in order to appear good in the media and all that kind of stuff. And not all that doesn't always happen. How many promises have we had broken by politicians? And the same thing happens with businesses. Businesses can announce new big projects and then, for whatever reason, change. Go, actually, this isn't in line with our strategy, or actually, we've lost a bunch of money. So I can think of loads of cases where that has been the case. So
it's not always like the politician has lied and just said what they wanted to say to get in.
No, they're not always
sometimes
liars, right?
It's like, priorities have changed and we need to reallocate resources.
Yeah. Exactly, right. And that's the better way. That's a better way to think about it rather than just like liars.
Damn, pollies.
So, but we can measure this, right? So you've got 5 distinct phases, and even if you just give them all a 20% weighting, that's going to give you a probability. That's going to give you a probability weighting that you can apply. So if there's $1 billion worth of announced projects, let me actually talk through the stages, right? So the 5 stages are early planning / announcement, mm-hmm. right? Planning. So that's like, okay, we started submitting the planning applications to councils to do whatever the project is. Tenders, okay, right, the project's been approved, we've got the plans, they've been approved, now we need to find the people that are going to start to do the project, so issuing of the tenders. Mm-hmm. Construction, okay, we're actually starting to build the project, and then completion. They're the 5 phases, right? So announcement, planning, tenders, construction, and completion. Now, completion is obviously 100%. because it's like, well, it's done.
It's done.
Now.
Yes.
It's done. Now, you want to look for projects that aren't necessarily at 100%, but there's also the reason that construction isn't at the 100% mark, or they've started, is because there are plenty of projects that get started that don't finish, right?
Yep.
So 100% would be completion because it's done, it's known. If you said that at the announcement phase, it was only 20%. So, there's a new announcement of $1 billion project happening in this town. How would you then assess what the probability is? We'd say, well, I'm going to give that a 20% rating that is going to come true. So therefore, I would assess the economic impact based on 20% of $1 billion.
Yep.
Easiest way to think
Makes
about it.
sense.
And then as it progresses through the stages, the probability of that coming to fruition increases, and therefore you can increase the weighting of that. And what the good thing is, right? Typically, there's going to be multiple projects happening in an area, so they're all going to be at different stages. So you get this nice little mix of different probabilities and total dollar values, and you can aggregate all of that. It's typically not one project. There might be 15 major projects happening in a local area, from small development through to major developments to public infrastructure, private infrastructure, all this kind of stuff. And you can start to weight that and then go, okay, what's the likelihood that this is going to come to fruition? And then going back to it. So what is the project dollar value divided by the population size, divided by the economic timeline, and which is divided by the completion probability. So that will give you a formula to understand what the ratio is that you need to look for. And again, it's just a case of looking at those numbers, finding areas, ranking them, rating them, assessing that versus the future supply risk, the current supply and demand, all of this kind of stuff. You can start to paint a really, really interesting picture around how to select these emerging markets.
I think these formulas are really helpful because
we've never shared any of these before.
Yeah.
I think Julian's going to hate me. So Julian, just for everyone's benefit, Julian is one of our team members who focuses on research here at Dashdot. I think he's going to hate me giving these away.
Why are you telling everyone? Yeah, but I think there's a lot of people that we speak to that, love doing this kind of research, but, being able to have a formula that you can, okay, I've got to find the project dollar values and I've got to stick that in the formula, and then I've got to find the population size and I've got to stick that in the formula, and building it all out, being able to put the information in a machine to then communicate a result to people. I think that's really helpful.
Yeah, totally. And again, look, this is 5. These are 5 key metrics. We've got 147. 147. Yeah. So,
we'll get through them all eventually.
We could do like one episode per key metric and just talk about that for the next 147 episodes. And then by the end of it, you'll be able to build your own research methodology, just like this. Yay. So yeah, but look, again, this is about identifying emerging markets, not necessarily the right properties, not necessarily the right strategy. It just kind of gives you some leading indicators to know where you're going. And again, go back to the start, like what we were talking about at the start of the episode was, we're not trying to time the bottom. We're not trying to just look for markets that have gone down in value and then we can go, ooh, maybe they're at the bottom now. What we're actually looking for is very significant indicators that show us that an area is transforming and why, and it allows us to look into the future a little bit as well. Awesome. Sweet. Cool. Well, I hope you've enjoyed this episode, guys. Gabby, have you got any other questions about this? Do you think this has been good? Do you think it's been a useful episode for people?
Of course, I think it's been good. I'm not going to say it's been terrible.
You could say that.
I'm not going to say that. No, again, I really think it has been helpful. I think it's always good to hear just like what are the 5 most important things, because there's so many, like you said, 147 that we use, but there's so many things that people, talk about as being like, this is the thing you need to focus on. But I really think if everyone can wrap their head around these 5 metrics, that's going to help. And as you said, it doesn't help with property selection or portfolio strategy or anything. This is purely about identifying emerging markets. But yeah, I think these 5 key, it's super valuable.
Totally. And again, it's like looking at all this kind of stuff together is the key, because you can look for vacancy rates decreasing and you can look for median rents increasing, and you could be like, ooh, could be a hotspot. But unless you look at what the actual supply and demand metric is, unless you look at what the project pipeline is, unless you look at what the future supply risk is, you could end up just buying a dud. You could buy a dud property at a dud location and not get to where you want to go. So, Awesome.
Cool.
All right, guys, if you've liked this, make sure you let us know, and make sure you share this with somebody else. Give us a bit of a vibe. We love feedback. We love hearing from you guys. It's really cool to see. We're actually nearly getting up to episode 100. This is episode 90 something.
Wowzers.
So we're nearly at episode 100, and we've
Cool.
and it's so exciting to constantly hear from new listeners, or maybe some that are new that I found the podcast and then just gone and digested all the episodes, and then they're just frothing over it, which is awesome. But also some of the people that have been with us for a long time that haven't let us know that they're listening to it, but have been listening to it for a long time. We love hearing from you guys. So let us know. Just send us an email to hello@dashdot.com.au. Give us some feedback. Let us know if there's anything specifically you want us to tackle. Like if there is a big burning question in your mind about how to achieve greater levels of freedom, choice, and abundance. It can be, more spiritually oriented. It can be property mechanics oriented. It can be philosophical. It can be whatever you want. If there's a way that we can tailor this content to better serve you and the whole you, not just the property you, because property is just one piece of the whole equation, right? Mm-hmm. So if you can help us to help you, then we would love to. So let us know. Shoot us an email, hello@dashdot.com.au. And as ever, we look forward to seeing you on the next episode.
See ya.